At Chapter 12, we're talking about long-term notes payable. Um, Looking at these, we're looking at other liabilities as well. But long-term liabilities, these are, as we said before, with long-term things, typically not due within 1 year. Here, what they say is within the entity's operating cycle, which usually we would mean a fiscal year. But we look at these, we have a long-term liability section of the balance sheet where we record these liabilities. And a couple examples we have might be like long-term notes payable, mortgages payable. So when we have a long-term note payable, what we can see here, Smart Touch Learning is signing a $20,000 note payable. Essentially, they are taking a loan, they're getting the cash. So debiting cash, crediting notes payable. Here we can see we have 4 annual payments of $5,000 plus 6% interest each December 31st. So our 6% interest will be based off of, actually, will be based off of the amount of the note payable. So an amortization schedule, when we look at it, this is a detail of each payment and what is applied to principal versus what is applied to interest. And we have here interest computed as the beginning balance multiplied by the interest rate multiplied by time. So again, the interest rate, when we're talking about this, we're talking about the interest rate per compounding period. So here's an example of an amortization table. Here, since we're looking at this in a yearly payment, we're seeing interest compounded yearly. This is our 6% multiplied by the beginning balance. And remember, what we saw was a $5,000 payment plus interest. So we're seeing here, we have the first year $6,200 payment. The second year we're looking at 6% of $15,000 because it is 6% of the balance that is due. And what an amortization schedule ends up showing is a running total of the ending balance and a running total of the beginning balance. And remember, the beginning will always be the ending of the previous period. So when they make their first payment, we debit notes payable because we're reducing the amount of that note payable by the amount we're paying to the principal. We have an interest expense, that's our cost of borrowing the money. And then again, of course, we would have the credit to cash because we have to pay the amount that is due. So mortgage payable, these are typically loans that are for a building or property, and usually what it says here, they're backed with the security interest in the specific property. So we're very similar to long-term notes here. And we have an instance where Smart Touch purchased the building for $150,000, paying $49,925 in cash, and signing a 30-year mortgage for $100,075, 6% interest that is payable in $600 monthly payments. So if we think about this, we're going to look at our interest per period is going to end up being our 6% divided by 12, which would be 0.005 or 1/2 of 1%. And here's what we're looking at. Here's our interest payment on the first, the balance we have when we take out the loan here, the $100,075. Our principal payment and interest expense, how we get that? We have our total payment here. And what we do is we calculate the interest on this beginning balance. And we always go forward with the idea that interest is paid first. So of our $600, once we calculate the interest on this balance, we deduct that amount from the total payment, and that is how much is applied to principal. Now what happens here is this amount of principal is deducted from the beginning balance to give us our ending balance, which in turn becomes the beginning balance for the next period. So here's our first mortgage payment. We have here We're debiting the mortgage payable. This is the deduction in the liability that we see. Our interest expense is the cost for this period, in this case it's a month, of borrowing this money. And then since we have to pay in cash, we're crediting cash for the $600. Now, bonds payable is a little different. We'll probably get into some in-depth discussion. There'll be a lot of problems on bonds payable coming up. Bonds payable, we've talked about debt and equity securities in the last chapter, or the last two. And a bond is essentially a loan that an individual or an entity, such as a business, a fund, gives to a company or a municipality or a separate financial entity in exchange for the promise to repay a fixed amount in the future plus dividend, or what they might call coupon payments now. So the face value is what is paid back at the maturity date to the holders of the bond. So what we can see here is face value is the same thing. We have different terms for this. Face value is the same as the maturity value, which at the beginning is the same as the principal amount, and which is equal to what we'll see later on as par value. Now, maturity date is when the loan has to be paid back in its entirety. And the interest rate, we've talked about interest rates before. This is what is stated on the bond is essentially the interest rate or the annual percentage rate that is paid on that face value. So again, we can see some similarities here with terms between stated rate, face rate, coupon rate, and nominal rate. So, for example, looking at a sample here, we have a 5-year 9% bond issued at face value of $100,000, which essentially means that if it's issued at face value of $100,000, that means that whoever's buying the bond is paying $100,000 for the bond. And a 9% bond, they will receive 9% of the face value in dividends or interest per year. So every year that an individual holds this bond, they will receive $9,000 in interest. Now, this is a 5-year bond. We're paying 10 semi-annual interest payments. So essentially, we're looking at not 9%, but remember, with our principal, or interest is equal to principal times rate times time, we look at this based on a time perspective, and semi-annual would be twice a year. So in this case, we're getting essentially 4.5% or $4,500 two times every year to equate to that $9,000. So what we'll see here, and here's a little graphic of this, is every 6 months, and we can see through the date here, we're getting these interest payments. So over the time of this bond, we're going to get $45,000, and then at the end of the period, we will be paid back $100,000 if we are the holder of this bond. If we're the issuer, then we have to pay interest of $4,500 every 6 months to whoever holds $100,000 of this bond. And at the end of 5 years, we have to pay them back the $100,000 that we borrowed from them. This is an example of a bond. When we look at types of bonds, we have term bonds. And in a term bond, they mature at the same time. At a given date, there is a specific term that they're mature at. A serial bond are bonds that mature in installments. Secured bonds, these give bondholders the right to take specified assets if the company has to liquidate or if they fail to pay the principal and interest. And debentures are unsecured bonds. These are only backed by the credit rating or credit worthiness, as it states here, of the bond issuer. That's why we see S&P and Moody's issue credit ratings to companies, because it helps investors to determine if that company has the credit worthiness to receive a loan from that investor. So a bond can be issued at any price agreed upon, And we have to think about this in a couple ways. If a bond is issued at face value, it's issued at what essentially the maturity value of that bond is. But we can have an instance where a bond is issued at a discount, which means whoever purchases the bond pays less than the face amount for the bond. For example, if the bond has a face amount of $100,000, that means at maturity date, whoever issues the bond is paying the holder of the bond $100,000. But the holder or the prospective holder of the bond may pay less than $100,000 for that bond. They may pay $90,000 or $95,000. And when we see a premium, that's the opposite. That is when we have the issue price above what the face value is. So in the same case for a $100,000 bond, it may be issued at $110,000. Now you may ask, why would we do this? Well, the reason is because we may see instances where a bond pays a higher or lower rate of interest than what someone can get in the open market, which can make the bond more attractive or conversely less attractive to an investor. So we have price information for a bond here. We're looking at it. Now, we're seeing here that 12 of these bonds have traded, and we're seeing that these bonds are a 9% yield. The highest price on this day is 79.5, which means we're looking at basically 79.5% of the face value of the bond. The low being 78.45, we're looking at that based on 78.45% of the face value of the bond was the low price, and what it closed at is just the last trading price of the day. Present value and future value, as we look at them, and this is probably one of the most, if not the most important concept that we will cover in accounting, means that we're looking at money earns interest over time, and the time value of money is recognizing that that money does earn that interest. The present value is the amount today that a future value of money would be worth, and the future value is the value in the future that a present sum of money may be worth at that point in time. So when we look at this, there's going to be some things here, and I'll try to go through this as distinctly as possible. But when we assume that a $1,000 bond reaches maturity 3 years from now and carries no interest, $750 is a fair price. That's an assumption. So you're investing $750 now to receive $1,000 later. You're going to earn $250 over the 3 years. We talk about a stated rate. That's the rate printed on a bond. That's the interest that the bond pays. Now, the market rate is a completely different thing. They can also call this the effective rate, but for most intents and purposes, we will see this as this market rate. Now, that's the rate that investors demand to earn for loaning their money, or in essence, you can think of that as that's the rate that can be gained on the open market. Okay, so if we look at this, if the rate on the bond is 9% and the market rate is 9%, well, the bond's going to be issued at the face amount or the face value of the bond. If the bond's rate is 9% and the market rate is 10%, well, if you think of it, you would rather get 10% on an investment than 9%. So to make that more attractive, the bond is issued at a lower price than face value, what we call a discount. And if the rate on the bond is higher than the market, then that's more appealing to investors. So a company or issuer of a bond can charge what we call a premium, which is where we're above the face value of the bond. Now, bonds versus stocks. Bonds are essentially loans, where stocks are ownership in a company. And it says debt is a less expensive source of capital than stock and does not affect ownership percentage, because if you're selling stock, you're selling ownership in your company. So, when we talk about this is an important concept to know. If we earn more income on borrowed money than what we see on interest expense that we're paying, then that's financial leverage. Now, issuing bonds versus issuing common stock, here's where we can have two issues. In number one, we're issuing $500,000 of 10% bonds payable. Here we're issuing $500,000 of common stock. And we're looking at comparing these two things. Well, if we look at it in a sense, net income before we're doing this project, and this is what we're financing the project by, is the $500,000. Well, we're going to be equal here in what the net income is beforehand, and we should be the same on what we anticipate income to be once we instill this new machinery plan, whatever we're doing. However, with a bond, we have to pay interest, which is here. So when we look at it, our income before tax for a bond is going to be $150,000, whereas if we're doing this by issuing stock, it's going to be $200,000. Now, if we take a 40% tax rate, we can see we'll pay $60,000 on tax here, where we'll pay $80,000 over here, and that's based off of our income before taxes, which means we see now a net income on this project of $90,000 with a bond, $120,000 with common stock. And if we add that to the net income that we had before we started this project, we can see we have a $30,000 increase here in common stock. But our earnings per share, for shareholders, this would be much more attractive with a bond, because shareholders would see a $3.90 earnings per share that they hold, whereas when we're issuing stock, it dilutes the value of the stock because the company is only worth so much. And if we think about this in a fraction form, and we had the value of the company over what we're looking at as the number of shares outstanding, we should know that every time the denominator increases, this number as a whole is going to get, ooh, that's a nice arrow, is going to get smaller and smaller. Just like if we have 1/2 versus 1/3. Well, 1/3 is smaller than 1/2. We've increased the denominator. And that's a way we want to think about this. So when we're journalizing transactions for bonds payable and interest expense, we're going to look at this, first of all, using this straight line amortization, which we should be somewhat familiar with straight line concepts from depreciation. So when we look at bonds payable, journal entries are required to record the issuance of bonds at face value. We have to either issue them at face value, or at a discount, or at a premium. There's only three options. So when we issue them at face value, what we have here, Smart Touch Learning has $100,000 of 9% bonds payable that mature in 5 years. The company issues these bonds at face value. So it's a $100,000 bond. Well, when we issue the bonds, we're getting cash. We're borrowing money. So we receive our cash, we debit it here, but we create the liability that we have to pay back in 5 years of the bonds payable for $100,000. Now, we get interest on this bond every 6 months as if we're the holder of the bond. So what this means, and it's stated on this slide that we had 9% here. So going forward, we look at this, well, if we get this bond twice a year, we know that should be 4.5% each time, because 9% divided by 2 for semi-annual payments is 4.5. So when we multiply that 4.5 by the face value, this $100,000 on the bond, what we're seeing is an interest expense for the company of $4,500, and then they're paying that to the holders of the bond, so we have to credit cash. Now, if we offered a discount, okay, we're going to see Smart Touch issues $100,000 bond. There's our face value. There's our coupon rate. What we see is 9%. The bond is paying 9% interest to whoever holds it. The market rate of interest is 10%. So what we're looking at here is Smart Touch actually receives $96,149, and we have a discount on this bond of $3,851. Now, when we look at this discount is a form of expense. That's a cost to us from the company. We're receiving $96,000 in cash, $96,149. Our bond still has a face value of $100,000 as our liability. So the difference between the two is our discount. Here's a T account of what this looks like. Here's how we report the bonds payable on the balance sheet. We have bonds payable. We're subtracting the discount on them. So we can see there we're recording these bonds at $96,149. Now, discounts are contra accounts. This is like our accumulated depreciation we have to an asset. Bonds payable minus the discount amount gives us the carrying amount of the bonds. So when we look at our bonds payable here of $100,000 less our discount, this is what we're looking at for the carrying amount. So when we amortize these, we're looking at this from a straight line amortization record at this point. We had an initial discount of $38.51. What we're going to do is, because we pay interest on this bond 10 semi-annual periods, we divide the $38.51 by 10 to see that we have $385 that we essentially have to credit to that discount. Because as time goes by, it's sort of like what we see with depreciation in a sense. We have to get that discount on bonds payable off of the balance sheet at some point, and we do this by amortizing it by essentially the full discount amount or premium amount, but that's a little different. The full discount amount divided by the number of periods that we're compounding interest. Since it's a 5-year bond and semi-annual payments, that means we're compounding 10 times or 5 times 2. So we have to pay cash out that $4,500 for our interest payment, and we have the discount here on the bonds. When we add those up, that becomes our interest expense. So we do the same entry each time we do this, and then if you'll notice here, our discount is decreasing. So the carrying amount on the bond increases, and at a point where we get to the last payment, the last interest payment on the bond, we'll see the bonds payable amount and the carrying amount will equal. Okay, so here's straight line amortization. Here's where we have the carrying amount. Here's the cash paid. Here's our interest expense, and that is gained by adding the discount amortized with the cash paid out. So as we go forward through this bond, this carrying amount is going to increase until we get here to $100,000, at which point, as the issuer, we have to pay that amount back to whoever the holder of the bond is. Now, if we issue bonds at a premium, that's when we have the rate on the bond higher than the market rate. And this makes it more attractive to investors, because you can invest your money in a situation like this and receive more than you would on the open market. So premium bonds payable is an adjunct account to bonds payable, which means that it's directly related to that account. Now, when we look at this, Smart Touch Learning issues its 9% 5 years bonds when the market interest rate is 8%. We ought to automatically know, since the rate on the bond is higher than the market, that this bond is going to be sold at a dollar amount that's higher than the face amount. So if the bonds are priced at 104.10, which means for every $100 in face value of the bonds, the bond is sold for $104.10. Since we have $100,000 in bonds payable, then what we look at is multiplying the 104.10 by the amount 100, which would be how many hundreds we have in 100,000. So we see that Smart Touch Learning receives $104,100 cash, and a premium we credit, because we think of this as a form. In a sense, theoretically, it is additional revenue. So after we post, we can see here we have the bonds payable. Here's our face value. Here's our premium. So our carrying amount on these bonds is $104,100. And as we go through amortization on this number will go down until it reaches $100,000 at the end, or at the maturity date of the bond. So the beginning premium, and we're looking at it here, is $4,100. There's 10 semi-annual interest payments during the bond's 5-year life. Therefore, we divide this 4,100 by 10 to get $410. Now that's how much is amortized. Now here's what happens in this case. Remember, our cash payment out doesn't change. However, we have to debit the premium on the bonds payable here, which means our interest expense is actually lower. So what we'll see here is after, I don't know, this is 2 payments. After 2 payments on the bond, we can see the carrying amount now has fallen to $103,280 from where it was $104,100 earlier. And here's an amortization schedule in this case. Now look, if you look here, you can see the cash paid out doesn't change. However, the premium is deducted from the cash paid to get our interest expense. And the carrying amount, as we look at it, as we get closer to the maturity date, the carrying amount decreases in this case. So how do we journalize these when we retire them? Well, when we retire bonds, that's paying the face value of the bonds. They can be retired at maturity date. They can also be retired beforehand. And when it's matured, the carrying value always equals the face value. So if Smart Touch has $100,000 in 9% bonds that mature on December 31st, 2022, when we retire these bonds, essentially we're paying the face amount out in cash, and we're debiting that bonds payable, which means we're taking that liability essentially off of our books. If we retire before maturity, well, sometimes companies may do this because they don't want to keep paying those interest payments. And in many cases, we'll see these bonds called callable bonds, which means the company can call them back from the holders and pay them off at a specified price. So if Smart Touch has $100,000 of bonds payable outstanding, with a remaining discount balance of $3,081, the company can buy the bonds in the open market for $95, which is essentially 95% of what we're talking about here. And in the case of a $100,000 face value bond, that's $95,000. So we see the face value, and since this is a discount, we're subtracting that to get the carrying amount of the bonds. And then the market price paid is $95,000. Well, what this means is we get a little bit of a gain on the retirement of those bonds, because the value of them currently is $96,919, but we're only paying $95,000 for them. So this entry we see here, this is the retirement of the bond. Our bonds payable when we retire will always be debited at the face value. Now, we've got a discount on bonds payable. We have to credit that. We have to credit whatever that is at the current time. We also have to credit the cash we're paying. So the difference is, if these two items combined are less than the bonds payable, we have a gain. If they're more, we end up having a loss, which would be debited. So when we retire before maturity, we have to record the partial period amortization of the discount or premium and partial period interest that we've accrued up to this point. We have to remove the unamortized discount or premium, and we have to debit the bonds payable at face value. This is very similar to gains or losses on assets that we've seen in the previous chapter. So how are these liabilities, bonds, essentially reported on a balance sheet? So current long-term liabilities, we should know this is reported on the balance sheet. The balance sheet lists assets, liabilities, and equity. It's in a way, the foundation of the accounting equation of assets are equal to liabilities plus equity. So when a company issues bonds, a discount or premium is included in that section. So when we see down here, we can see here in long-term liabilities, we have bonds, and we have bonds payable here of $100,000. The discount is deducted, which gives us the carrying amount on the bond. So in this chapter, we're looking at debt to equity ratio. And when we look at debt to equity, what we're saying essentially is, how are we using debt, or are we using equity in the company to finance things. So if we have a ratio greater than 1, that means we're financing more assets with debt than with equity. It means we're borrowing money as opposed to selling interest or ownership in the company. So for Kohl's, we have total liabilities and total equity in millions. And when we look at this, this is the fiscal 2015 annual reporting. So we can see in January, at the end of January 30th, 2016, we had total liabilities of $8,115 million and total equity of $5,491 million, which, if we think about that, we add three more zeros on the end, and we're really looking at $5 billion and $8 billion. Okay, so their debt to equity ratio, as we look at it, essentially, remember, a lot of these ratios just say what they are. It's total debt or total liabilities divided by total equity. So in this case, Kohl's has a 1.48 in 2015, which means they're financing more with bonds and debt than they are with ownership in the company. And in 2014, it was 1.39. So it looks and appears as if, in some way, shape, or form, they've either taken on more debt or they've reduced the amount of equity that's held within the company. So when we use the time value of money to compute present and future value, and there's an appendix in your text or in the online, the e-text version that explains this, what we're looking at is a dollar today is worth more than a dollar received in the future. And some people may say, well, why? That might be inflation, increased cost of living, but that dollar you receive today, you can do what you want with it. So invested cash earns interest over time, and this is called the time value of money. Time value of money is used to determine the present value of a bond, or it's what we call its market price. So we have to know a few things here. Now, we discussed some of this right before we had our little hiatus here, but we've got a principal amount, which is the amount the investment or borrowing as a lump sum or an annuity. An annuity is just where we have equal payments spread out over time at equal periods. So the number of periods is the length of time we have, and the interest rate is a percentage earned or invested. And remember, this may be expressed as an APR, and it usually is for an annual percentage rate, but we have to convert that into a percentage. Well, I shouldn't say a percentage. What I should say is a rate per period. So simple interest. When we talk about simple interest, that's interest is calculated only on the principal. Compound interest means that we're taking the principal, we're adding the interest to it, and that becomes the new principal, which when we put interest on it again, we're adding interest again, which becomes the new principal. So this builds. This might be a little pile that's this big, and then it gets to be this big, and then it's this big. So when we see compound interest, we're adding interest to the principal, and that amount of those combined becomes the new principal. In simple interest, that doesn't work that way. So simple interest versus compound, here's a graph that shows this. If we look at simple interest, we're just taking the principal multiplied by the interest rate, meaning we get $600 in interest each period. So at the end of 5 periods, we'll have $3,000 in interest. Well, what we do in compound interest is the same thing happens here as happens here. We're taking 10,000 times 6%, which means we've earned $600. Nothing's changed there. But for the next period, that 600 is added to the previous period's principal. So we now have $10,600 in principal here. And when we multiply that by 6%, we can see the interest rate here is greater than there. And that's what happens with compound interest. So the future value of investment in the example we're looking at here, when we come back to this point, we saw all the interest added on this from a compound interest perspective means we have $10,000 at the start. After 5 years, that 10,000 is going to be worth the 10,000 plus the 3383, or $13,383. With simple interest, that $10,000 at the end of the time will only be worth $13,000. And this is illustrated here. The future value is equal to the principal plus the interest earned. If we know the future value and want to find the present value, well, we can rearrange. This is an equation you should know through algebra, that we can rewrite this equation. We can subtract interest earned from both sides, and we get principal is equal to future value minus interest earned, and that would be our present value as we think about it. So we do have some formulas. I'll probably talk about those more in a video. But for all intents and purposes, you will be using present value tables to calculate what we're going to do. And you do have tables in your book. And it's very important to note the differentiation between these tables. The present value of $1, first of all, we're talking about present value. So we want to know what's it worth today, what's it worth right now. And when we say $1, we're talking about a lump sum. We're not talking about payments every period. We're just talking about the present value of a lump sum of money. Now, the present value of an ordinary annuity, that's what is it worth today if we make equal future payments or contributions or amounts, what we consider to be annuities. The future value of $1 just means if we have $1 today, what's it going to be worth in the future at some point? And the future value of an ordinary annuity means if we make either periodic payments or deposits of the same amount over a bigger time span, what will we have at the end of that time span making those equal payments? So, if we want to know how much will we need to invest today to have $13,383 in 5 years if the interest rate is 6%? Well, if we look at a present value factor from the table that's in your text, and we look at this, what we'll see is we know our rate is 6%, and our N, or number of periods, is 5, because we're looking at this from 5 years, and they don't distinguish semi-annual payments or not. So we're looking at this as annual payments. So basically we're compounding 5 times at a 6% interest rate. Now if we look at that from the table, we'll see we get a rate of 0.747. So when we multiply the future value by this rate, we'll get $9,997. Now because these tables are missing the rest of the decimals here, we will have a rounding error whenever we use a table. Present value of annuity, this is where we have these equal payments over equal intervals. Okay, so let's assume that instead of receiving a lump sum at the end of 5 years, you're going to get $2,000 at the end of each year. So you don't get $10,000 after 5 years. You're getting $2,000, $2,000, $2,000, $2,000, $2,000. You're still getting the $10,000, but you're getting it every period. So the present value of this, we use a different table. Our interest rate is the same and our number of periods is the same. But this time we have a different factor, but we're using the amount of payment to determine this. So the present value of an annuity here is somewhat an amortization table in a way, where we can see what happens here. If we have 8424, that's our present value, okay? We're adding 6% interest, but we're subtracting the $2,000 that's withdrawn. So as we can see, when we get to the end of this period, we get 0 as an ending balance. We can use the present value of a lump sum and present value of an annuity to determine the selling price of the bond, okay? We want to know the present value of the principal and the present value of the interest rates. Now the present value of the principal amount, this is going to be a lump sum. And when we look at present value of future stated interest rates, this is going to be the annuity. So if we issue a $100,000 5-year 9% bond that pays interest semi-annually, again, that's 4.5% per compounding period. Okay? We know the maturity. We know in the future it's going to be worth $100,000. We know interest every period is 4.5% of this 100,000, which is your 4,500. We know the interest rate. Now, here's where we have to be careful. When we calculate the value of the bonds, we always use the market rate. I cannot stress this as enough. I cannot. The market rate is what we use to calculate these values. Okay? We use this 4.5% rate to calculate how much interest is paid on the bond. You have to understand this. The market rate is used to calculate the present value. The interest rate on the bond is used to calculate the amount of interest payment the bond issuer pays. So our interest rate is 5% semi-annually. The number of periods we have, well, this is a 5-year bond paid semi-annually. We have 10 payments. So basically, this is our R, this is our N. So the present value of the principal, or the present value of the face value of the bond, that's a lump sum. We're getting $100,000 at the end. That's the present value of $1. If we look at this from a standpoint of 5% interest in 10 periods and we use our table, we'll see where those intersect. We get a rate of 0.614. We multiply that by that future value, and we'll get the present value of the $100,000 at the maturity date of the bond is worth $61,400. So we found there's two things we need to find: the present value of the principal, or the present value of the face value of the bond, and the present value of the interest. Now this is using an annuity table. And what we're going to do, the rate and the number of periods does not change. Okay? So, but when we look up on the annuity table, we'll see this has a rate of 7.722. We're multiplying that by the amount of interest paid on that bond every period. In this case, it's the 4,500. So the 4,500 times 7.722 gives us 34,749. That's the present value today of those $4,500 payments over a 10-year span. This number plus this number, when we add them together, that gives us what the bond is worth at the current time. Okay, so here we have issuing 9% bonds. The market rate is 10%. We ought to automatically know, comparing these, the bond is issued at a discount. So when we look at the, let's see, 5-year 9% bonds that pay interest, yeah. So we're issued at a discount. There's our $4,500. We have, this is wrong. It should be 9%. It should be 4.5%. So we, yeah, they list 4% here, but I don't think this figure is right. They list 4% here, but we're looking at 9%. So we've got to disregard that. Let's see. When we journalize transaction for these, we may look at effective interest amortization method. This is something that I'll do in a video, because this will be something that's a little more, talking about it is going to be a lot more difficult to explain than going through it. So this is the PowerPoint for Chapter 12. Don't get frustrated over this chapter. This is a difficult concept to master, but once you get it, you'll see that it really is kind of an easy thing to calculate. I will be putting videos out. I don't know if I'll be later today, tomorrow, but you'll probably have quite a few within the next week talking about bonds payable. If you have any questions, comments, or concerns, use a discussion board, email, call, text. Other than that, stay safe, wash your hands, and study your accounting. Bye.